You're listening to Capital Topics, episode number 90. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss expected returns with Raymond Kerzérho, PWL's senior researcher. Enjoy! Good morning, James. How are you today?
I'm very good, François. How about you?
I'm very good, thank you. So, as I mentioned in my introduction, to help us tackle today's topic, we have invited Raymond Kerzérho, PWL's senior researcher. So, good morning, Ray. It's good to have you back on the podcast.
Good morning, guys. Thank you for having me again.
So, Ray, you have recently published an updated version of your financial planning assumptions for market capitalization weighted portfolio. But before we dig into the details of the report, can you give our listeners a brief introduction to this report and how it's used?
Yeah, sure. So real quickly, we've been producing this document for many years, and its fundamental mission has remained the same. So to be more specific, the report provides projections for a bunch of variables that are critical for investors, such as the long-term projections for inflation, returns, and the volatility of asset classes, This data is used by our financial planners at PWL when they prepare retirement projections for our clients. There's an important nuance, though. These are projections. As I always remind listeners, these are projections rather than predictions. We recognize that our expected returns estimates are subject to a substantial margin of error.
Okay, good.
Yeah, so for our listeners, I would recommend they go back to our podcast number 79. We published last year when we reviewed your update on expected returns. In that podcast, Ray, you explained in detail your methodology. So we're not going to do that today in today's podcast. But again, maybe you can just summarize for our listeners today what you do to prepare these expected return forecasts.
Of course. So what we do, we combine historical return data with forward-looking estimates. So it's really two components we put together to arrive at a single expected return for each asset class. Each approach has its limitations, but by combining the two, we hope that some of their respective weaknesses will offset one another and produce our best estimate for future returns. These projections are designed for a 30-year investment horizon. It's also important to emphasize that they are projections, not predictions, as I mentioned before. So yes, there's really a margin of error here. And over a given period, markets may significantly outperform or underperform these estimates.
So right now that we have covered the methodology, you update those numbers twice a year. You've been doing this for over 10 years now. Can you update us on the latest expected returns estimates? And are there any material changes compared to your report last year?
Yes, so let's go from the start. So the first thing we look at is really inflation. So our long-term projection is unchanged from last year at 2.5%. We also make a projection for the primary residence, which also is unchanged at 1%. 1% is a real number here. So it's the inflation is taken out of there. So 1%, and we must deduct maintenance and property taxes from that capital appreciation estimate. Looking at the bond market, we have two estimates for that asset class. We make an estimate for short bonds and one for the bond universe in Canada. So short bonds are up from 3.01 to 3.07. up 6 basis points. And the Canadian universe of bonds is up by about the same amount of basis points, from 353 to 358.
Okay.
Canadian equity is down from 7.01 to 6.87, so it's down 14 basis points. U.S. equity is down very, very modestly as well, from 648 to 644, minus 4 basis points. And where you'll find the biggest change in our estimates for expected returns is in international equity, which is down by 24 basis points to 7.04%. So it's about basically by about a quarter of a percentage point. Just to finish here, so on these, by the way, all these expected returns are nominal. They aren't adjusted for inflation, except, as I mentioned earlier, the one for primary residence. And the last thing I want to mention is that 60-40 balanced portfolio has gone down a little bit in expected return from 576 to 573, so basically down 3 basis points.
Right.
It's almost nothing, actually.
Okay.
One thing that I want to mention, why did international equity had such a decline in expected returns compared to all the rest? So it's clear that every equity asset classes has performed very, very well for the last 12 months, ending in June 2026. However, international and especially emerging markets have returned very spectacular, almost for 50%. I think it's like 49 point something percent for emerging markets. So that had a fairly a significant impact on the expected return for international equity.
Yeah, that's an amazing return.
So this is for the for a market cap weighted portfolio holding straightforward ETFs. At PWL, we invest with factor strategies, especially those provided by Dimensional. We make also...
by factored rate, we're tilting towards value, small cap stocks, and profitability stocks.
Yeah, thanks for the reminder. So, and we also make adjustments to the fixed income portfolio. Their methodology is a little bit different as well.
Correct.
So now what we've been discussing up to now was for a market cap weighted portfolio. So basic ETFs, index ETFs that you can invest with in the market. At PWL, we invest also with factor tilted funds, such as those offered by Dimensional Fund Advisors. So factor tilted mutual funds put more emphasis. They invest in the total market, but they put more emphasis on value, small cap, and more profitable firms.
Okay, right.
So first, starting with the fixed income factor tilted portfolio, we have an expected return of 3.19, which is like 34 basis points lower than our estimate for Canadian bonds that we had for the market cap weighted portfolio. The Canadian equity factor tilted portfolio is at 7.42%, which is 55 basis points above the market cap weighted equivalent that we've discussed earlier. The U.S. equity factor tilted portfolio is at 7.07%, which is 63 basis points above the market cap weighted portfolio. The international equity portfolio, which includes developed and emerging markets with a factor tilt, it's at 7.54%, and it's 50 basis points above a market cap weighted portfolio. Now, to close on this section, the 60-40 portfolio, a factor tilted portfolio, has an expected return of 5.95%, which is 22 basis points above our estimate for a market cap weighted portfolio.
Okay.
Ray, you highlight that the expected return for a balanced portfolio, 60-40, 60% equity stocks and 40% bonds, is 5.9 5%. That's before the advisory fee, let's say the PWL fee, but it includes the product and management expense ratios, correct?
Yeah, absolutely.
There's a lot of debate, though, around this classic 60-40 portfolio because the expected returns on bonds, even if you take market cap weight at 3.58%, that's likely to generate a negative return after you factor in, taxes and inflation in a taxable account. So add to this when you look at how well equities have performed over the last 20 years, despite major bear markets, equities have generated compound returns well above, your expected returns from 2016 and way above the current expected returns. And can you comment on all of this?
Yeah, it's always a problem with investing. In fact, investing inevitably involves a great deal of uncertainty. The fact that equity have outperformed their expected returns over the past 20 years does not mean that we should simply extrapolate those returns in the future. Expected returns are not predictions of what will happen. They are our best estimate based on the information available today. We also know with certainty, so we've discussed uncertainty before, but there's an element of certainty. We're certain that severe bear markets will occasionally occur. Fortunately, these are relatively rare. However, they are an unavoidable part of investing. This is where bonds play an important role. Even when their expected returns are modest, high-quality bonds can help cushion portfolio losses when equity markets plunge. That cushioning effect can be extremely valuable. It can give investors the confidence to stay invested through the difficult periods rather than selling equities after a major decline. In other words, the role of bonds is not simply to maximize expected returns. They also help make the overall portfolio more resilient and help investors stay the course when doing so is most difficult.
Mm-hmm. Yeah. Now, Ray, another topic similar to last year, expected returns on Canadian and international equities are higher than the U.S. Can you explain why?
Certainly. As I mentioned earlier, we estimate expected returns by combining historical return data with forward-looking valuation measures. For the forward-looking component, we use the Shiller price-to-earnings ratio. At the moment, U.S. equities trade at a higher valuation than Canadian and international equities. In other words, investors are paying more for each dollar of earnings generated by U.S. companies. All else being equal, the more investors pay for a given level of earnings today, the lower the return they can expect going forward. That is why our expected returns are currently higher for Canadian and international equities than for U.S. equities. This does not mean that we expect the U.S. market to underperform every year or even over every period. Rather, it reflects the fact that starting valuations are an important determinant of long-term expected returns.
Okay, thank you.
Ray, your expected returns, last year you did a comparison of other major investment firms that actually also produce what their expected returns are. What do you have to say about this year?
That's an interesting question. Since we project an expected return of less than 6% for a balanced 60-40 portfolio, it might be tempting to conclude that our estimates are overly conservative. But when we compare our projections with those of other major firms, such as BlackRock, Vanguard, and AQR, we actually find the opposite. Our estimates are more optimistic than those of these large investment firms by at least half a percentage point. So while a sub 6% expected return may seem low in absolute terms, it is relatively optimistic compared to the projections published by many of the major investment firms.
That's interesting. Now let's review how actual markets returned over the last 10 and 20 years compared to the expected return projections for globally diversified portfolios. We will refer to the PWL Market Statistics Report and the Parkyn, Doyon, Rochelle, the PDL Model Portfolio Report. All reports are as of June 30th, 2026. So, James, let's get right into it.
Well, François, as our regular listeners know, we produce the results of our model portfolios for a range of asset mixes allocated between stocks and bonds. And this table of results shows performances over 1, 3, 5, 10, and 20 years. It's really useful to compare actual portfolio results for clients and for listeners. Today, I will compare the performance results for the last 10 and 20 years. So really looking at the long term.
Mm-hmm. So what would you like to highlight, James, for listeners?
Okay, well, first of all, the last 10 years and 20 years, François, compound returns have been extraordinary. For instance, and I'm going to highlight the returns for the most common asset allocations for our clients. So please keep in mind these returns are pre-PWL fees, but include the cost of the investment products. So let's start with the classic balance: 60% stocks, 40% bonds. The 10-year return was 8.45, 20 years was 7.12, and the current expected return for this allocation is 5.95. So again, a big differential. If you go more aggressive to 70% stocks and 30% bonds, the last 10 years were 9.62% and 7.79 over 20 years. And the 2026 expected return is 6.35. The 80% stock portfolio is 10.78, and the 20% bonds is 8.46. And again, the expected return in 2026 is 6.73. So across the board, the portfolios over 10 and 20 years have done much better than what we're currently forecasting for the future.
Yeah, it's I think really using the past 10 or 20 years as a primary basis for setting long-term return expectations would be a mistake. Those periods have been very strong, but they represent only a small portion of investment history. Our estimates are based on approximately 125 years of historical data rather than on the most recent decade or two. And even then, we make downward adjustments for certain factors that contributed to the exceptional returns of recent decades, but are unlikely to be repeated to the same extent in the future. The key point is that strong historical returns do not necessarily imply equally strong future returns. For long-term planning, we believe it is more prudent to look at a much longer history and to consider the valuation and economic conditions that investors face today.
James, these are compound annual return. What does that mean for capital appreciation or accumulation?
Well, again, for our listeners, François, that's a great question. The easiest way to explain it is if you invest $1 today at these compound rates, what would it represent after 10 or 20 years? So again, I'm going to illustrate for our listeners. The balanced 60-40 portfolio after 10 years is $2.25. So if you had 100,000, it would be 225,000. After 20 years, you just have slightly less than $4, that is 3.96. So 100,000 would have become 396,000. Again, if you increase the equity allocation because the returns were higher, for 70-30, you'd get $2.51. And for, 20 years, $4.48. And then even more aggressive, 80% stocks, 20% bonds, you'd get $2.78 or 278,000 after 10 years on 100,000 invested. And then 20 years, a spectacular 5 times $5.07. Yeah. So you'd have over $500,000.
5 to 1.
Yeah. And again, that's a globally diversified portfolio. That's not making single individual stock bets where you hit it out of the park and get lucky with a mag stock here.
Right.
So yes, but these are really past returns. We should be grateful for the great returns, especially those who were invested for all that time. However, looking forward, I think a reasonable dollar estimate, for example, for over 10 years for the 60/40 portfolio would be probably 20% lower. So basically, from basically $1.75 instead of $2.25. And a longer estimate would be even at even a bigger discount. So once again, always the same problem or danger to project the recent past in the future.
Right, right. James, what can we learn now from these results?
Well, again, Raymond has given us a lot of warnings about not projecting what's happened in the last 10 and 20 years into the future. And that's really important for, for listeners to take away. I have 4 main lessons, François. My first lesson is to stick with your plan. Staying on course gives you the best long-term results. So when we look at the models, that's somebody who's stayed invested, not somebody who's buying in and out or market timing. Correct. And we've made that point many times, as you well know, François, in our podcasts over the years. These performances numbers, in effect, now back up, the don't time the market. So despite, all of this, keep in mind the last 20 years, capital market crises, think the 2008, 2009 global financial crisis where the global banking system was in peril, the pandemic in 2020, the resurgence of high inflation in 2022. Again, throughout all this, stocks generated returns compound well above long-term averages and significantly stronger than Ray's latest projected expected returns. I do, however, agree with Ray's assessment that we shouldn't assume the next 10 and 20 years are going to be the same.
Right. As you stated earlier, the actual returns for a 60% stock and 40% bond portfolio was 8.45 compound over 10 years and 7.12% over 20 years. This is 2.5% compound extra return every year for over the last 10 years and 1.17% over 20 years. This means an investor who stayed the course would have accumulated about 25% more capital compared to the 5.95% we project currently.
Well, again, François, this can be explained because actual returns on stocks were much higher than their expected returns that we set in way back in 2016. For example, the actual performance of the All Country World Index over this period was 14.3% in Canadian dollars for the last 10 years, which is 2 times what was predicted in the 2016 expected return for stocks at 7%. So again, that just shows how powerful, the gains have been over and above what was expected in the last 10 years.
Right. Now, what's your second lesson, James?
My second lesson, François, is the actual returns on bonds were below the 2016 expected returns for bonds. So we expected 3.3. The actual result was 1.71% in Canada for the total market. Now, inflation over that period was 2.79%. So bonds generated a negative return even before factoring in taxes.
Mm-hmm. The same goes for the current expected returns for bonds of 3.19%. When you remove both taxes and inflation, you end up with a negative return. Investors really need to think about the long-term impact of high inflation with the safe bucket. What's your third lesson, James?
Well, my third lesson, François, is that setting a long-term allocation with a higher allocation to stocks generated much better long-term results. We saw that. So yeah, you could argue it's data mining. We're, as Ray pointed out, 10 and 20 years are very short periods in terms of the history of capital markets. But when we compare the results of 60% stocks and 40% bonds, which is the classic balanced account, which generated 8.5% compound over 10 years, the 70-30 portfolio generated 9.62 or 1.17% per year better. So again,
Yeah, with that portfolio, you would have accumulated 11.6% more capital. And with an 80-20 portfolio, you would have generated 23.6% more capital. That's a big difference. Of course, you don't get that upside without the downside risks that may come.
Well said, François. I agree with you. So now for my final lesson, really all of our listeners should be clear that they should know their risk. That is to say, you should know how much risk they have in their portfolio. And so after a decade, 20 years of excellent returns on stocks, investors need to make sure their portfolios are consistent with their plan, their objectives, their risk tolerance, and risk capacity.
James, there was an interesting article in the Wall Street Journal on July 7th written by Robert Posen, former head of Fidelity Investment, titled, "You're Probably Overinvested in Bonds." He argues in favor of a portfolio composed of 90% stocks and 10% in money market funds. To me, Posen's main argument are heavily based on the market performance of asset classes in the last 20 years. What do you think?
Well, I completely agree. I think he may be falling prey to data mining here, and to raise point that if you look at a much longer period of capital market history, that will give you better information. So then I would, for our listeners, remind them that our current portfolio performance results are measured as at June 30th, 2026. And this has been an absolutely extraordinary period for stocks. As we said, twice the returns based on the all-world stock index. So the risk, I say, for all of us with recency bias and other behavioral, economic challenges that are well known, the risk again is that we fall into that data mining trap. So to that, our Ben Carlson, who we really like and we quote him often on our podcast, he also wrote a blog about that Wall Street Journal article, and he makes a bunch of counterpoints that I think are worth sharing with our listeners. So I'm going to quote him. Here goes. For investors still putting money into the market on a regular basis, lengthy drawdowns are an opportunity, not a risk. You get to buy stocks at lower prices. You have a much smaller margin of safety when you get into retirement. That is, there's generally no more income from a job to buy stocks when they drop and they're on sale. So you don't have nearly as much time to wait out, a painful bear market.
Yeah. Posen also writes that rising life expectancies expands an investor time horizon. To me, this is where a skilled advisor can really add value, helping client make the right long-term asset allocation decisions. Overall, James, I believe that what you're saying is that many investors should perhaps consider a higher allocation to stocks for their long-term asset allocation, given the low expected returns of bonds. Is that correct?
Yes, François, and I'm not proposing this as market timing advice, but rather in the context of a long-term strategic, decision where investors' allocation reflects their risk tolerance and their risk capacity.
Yeah, well, I agree, James. And as I said in the conclusion of our most recent podcast on the mid-year market review, these decisions are not about market timing or predicting what comes next. It's about building a portfolio that is right for you and constantly bringing it back to your long-term asset mix when it deviates because of market movements. Remember, rebalancing your portfolio keeps risks in check, reinforces discipline, and helps you stay invested through whatever surprises markets will throw at you.
Yeah, and François, I would add to that as a final point for our listeners, our usual mantra: make a plan, be globally diversified, stay disciplined in difficult markets, and then rebalance, but stick to your plan.
All right, so we'll conclude here. So thank you, Ray, for your participation today. As usual, this was very interesting, and I hope our listeners have found it interesting as well.
My pleasure, François.
I remind our listeners that Raymond's paper on expected return can be found on PWL Capital's website in the Learn section. Also, thank you, James, for your contribution again today.
My pleasure, François.
So that's it for episode number 90 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on September 3rd. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. See you soon.